Another one that isn't that well known but might be useful for people who haven't owned or haven't lived in a property that they've owned. So you could have an investment property but not ever actually lived in it. You may be eligible for the first home savers account. I've run into some pastors who are eligible for this particular account because they've lived in a manse their whole life, or a church provided property. They may have actually owned an investment property but never actually lived in it. They are often eligible for what we call this first home savers account. Or you might be, in other scenarios, you might be wanting to assist your children or grandchildren save for their first home. Now, it's not that commonly known because the financial institutions that operate it don't make a lot of money from it, and there's also a requirement that you need to put in $1,000 over 4 financial years that has prevented a lot of people. They feel as though those restrictions are too much, and so they haven't actually taken advantage of the account. But for somebody like a minister who's not lived in a home that they've owned, they could use it to boost their super as well, because you can only use this account for 2 purposes. One is to buy your first home that you're going to live in, and the second purpose you can use it for is to direct it to your superannuation. So it could be used as either a way to buy your first home or to boost your superannuation. How it works is that you can put up to $12,000 into the account each year, and so $12,000 each year, and the government will match it with a 17% co-contribution on the $6,000, the first $6,000 of it, which means 17% of $6,000 is $1,000. So generally I don't say put $12,000 into the account, but put $6,000 into it, get the $1,020 co-contribution, and then you can start to build your deposit for a home. A couple and a spouse can have an account each, so you can put $6,000 each into an account and get a $2,040 co-contribution, and then you get interest on it as well. So you add your 17% plus another 4% interest, you're getting over 20% return on that investment. So it's a really effective way to save. This is the key that put a lot of people off, because you need to contribute $1,000 over 4 financial years to be eligible for it. If you look at this particular scenario, you can actually access the account within about 2 years, because if we put $6,000, so we're saying here in this example we're putting $6,000 each. This is a couple putting $6,000 each into their own accounts this month, and they'll get a government co-contribution of $2,040. Over the year they'll get some interest, and so their total balance after a year would be about $14,500. Next year, June 2014, they'll do the same, another $6,000 each, another $2,000. They'll get a bit more interest. Now they're up to nearly $30,000 in saving. The following year they'll do the same thing, and in July of 2015 they do the same thing. They've got over $8,000 in co-contribution, they've got some interest, and within 2 years, it's only a bit over a month over 2 years, they've turned their $48,000 here into $58,000. So you can see, however, in 2 years it can be a really beneficial thing, and that might be, as I mentioned earlier, it might be your first home saver, or might be somebody who's never owned investment properties but never lived in those properties.